5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Monday. Europe prepares for a fight. Less than 2 weeks until the U.S. trade deadline, the EU gets ready to push back. Ishiba holds on. Japan's Prime Minister vows to stay on to negotiate tariffs despite his party's historic day election loss. And Europe kicks off a busy earnings season. Stellantis books a massive loss. For the U.S., it is big tech earnings on deck. So yeah, a busy week, the second busiest week by market cap for U.S. earnings. We get Alphabet this week alongside Tesla on Wednesday. And the summer melt-up continues into that. We're up by about 0.25% for both the S&P and NASDAQ. We're a little changed on Friday, so should we open here, we'll be at other all-time highs. Now, for this bond market, what a volatile and crazy week, I guess we could say, last week, from questions about Fed independence to picking through a CPI report to trying to see where tariff inflation hit. We are met with a rally this morning after positive UMich data last week alongside Chris Waller, the Fed governor, calling for lower rates, lower by about 2 basis points on your 2-year yield at 3.8, your 10-year yield lower by more than 3 basis points at 4.38. Let's get you now some stocks that are moving in the pre-market. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with a check on Stellantis. I know you just mentioned it there at the top. Down 1.4%. Their ADR is trading lower in the U.S. pre-market. This comes after they released some preliminary figures for the first half, pointing to a loss of 2.3 billion euros. There was some color of a impairment charge of around 3.3 billion euros that they gave detail. Now, Stellantis does report full results next Tuesday, so we'll await those as well. Moving on to stocks included in the S&P 500. One of those being added is Block, the payments firm Block. This is the owner of Cash App and Square. Those shares are up 9% so far in pre-market trade. That passive bid might help out this stock's name. It's going to be replacing Hess in the S&P 500. Now, Hess was acquired by Chevron on Friday, so that stock has now delisted. Lastly, let's move on to Alaska Airlines. Those shares are trading just slightly lower here, but unchanged, my bad, unchanged on the moment, but they did have to ground their flights, Danny, for 2 hours overnight due to another IT outage. This is the second IT outage for Alaska Airlines that's grounded its fleet this year. Danny.
Valerie, thank you so much for that. That is Valerie Teitel. We'll catch up with you later in this hour, and in just moments, Max Kettner of HSBC will give his current read to us on market signals later this hour. Amy Silverman of RBC joins to discuss another big week of earnings. Now, futures are rising ahead of a busy earnings week. Max Kettner gives us his read on the market right now, writing, quote, "There are some warning signs emerging. Specifically, our short-term sentiment and positioning signals are now sending a sell signal. And in fact, the biggest one since mid-2023. I'm pleased to say that Max Kettner joins us now. He's Chief Multi-Asset Strategist at HSBC. Max, really wonderful to speak with you this morning. It wasn't that long ago, in fact, the start of this month, that you doubled down on your overweight U.S. equity calls. So balance that with the concerns you're seeing on a more technical level now.
Yeah, good morning, Danny. Look, I think from a fundamental perspective, I think this rally can still go on a little bit further. I think equities still have, particularly in the US, a little bit room to run further, particularly with that reporting season. Let's remember that we're going into this reporting season with very, very low expectations. We've started it with consensus saying that earnings are going to drop sequentially, that they're going to see a quarter-on-quarter decline, even in tech that is so buoyed by by things like the weaker dollar, but also by continued capex spending on the AI side. Even there, consensus was saying we're only expecting flat quarter-on-quarter growth. So therefore, I do think the next couple of weeks still well supported. I do think we still can rally a bit further. But I think heading towards September, there's probably a bit more questions marks, like you said, around the technical side, around the sentiment and positioning side. Clearly, things are getting a bit more stretched. I do think long onlys, at least on our data, a lot of them have missed the rally. There's still a lot of subdued sentiment, barely any overweight in equity, actually still underweight on high yield on aggregate. But at least the shorter term signals from us are really now starting to flash. Again, that doesn't send an immediate sell signal, doesn't mean that we need to immediately get out. But I do think, in the next couple of weeks, put a couple of hedges on some of the cyclical parts of the market. Think in Europe, things like the auto sector. You were just talking about Stellantis, that sort of almost 10% rally, that 10% squeeze that we had earlier this month. Use those kind of squeezes particularly with vols, how low they are right now, with those low vols, really to put a couple of hedges on and lock in some of those gains.
Max, it is a bit different from what you've been saying, especially for the second half of the year when you've been really bullish. And I feel like what you've really been communicating well is that this market has been missing a lot of things that can go right. But the title of your note that you put out this morning is what could go wrong in the second half. Max, is that also an acknowledgement that there are greater risks to the downside right now than there are to the upside?
Well, there has to be, right, Danny? If you're as bullish as us, so we were around the table. It was like, do we have any upside risks? And like, actually, no, because we can barely be any more bullish. So from that starting point to have even upside risks, I think would be probably not the most prudent thing to do. So therefore, I think, but by definition, there's really only upside, downside risks. There are some of them that I am genuinely concerned about. Of course, things like yields going up again because growth is too good, or maybe goods inflation goes up. Fine, that can send us down a couple of percent, but ultimately, those are the kind of buying signals. The same thing is on the technical side that we were just talking about. That sentiment and positioning, once it gets too stretched, you know what, just put a couple of hedges on when vols are very low, and then something might be happening, right? I don't know, Trump saying something, or perhaps it's something on the Fed side of things, then obviously there is a bit of a higher height to fall from, but that doesn't mean the end of the rally. I think there is more fundamental things that I'm concerned about. Perhaps, for example, something like a retightening of the labor market, but for the wrong reasons, for the reasons of immigration flows going into perhaps even negative. That really would be something that fundamentally would make me concerned. Everything else is sort of tactically and technically driven pullbacks.
Max, is it a market more sensitive now then? Because it has been a market that's looked at tariff disputes, a lot of other concerns, and really has been able to brush it off. That has been extremely resilient in this melt-up we're seeing. Is it also your concern that that type of resilience, that type of lack of sensitivity ends as well?
No, I think let's talk again in a month and a half. Let's talk after the summer holidays. I think then, maybe I'll ask a bit differently. I'll answer a bit differently. But for now, I think it's this setup of the wall of worries plus really those really low earnings expectations that we had ahead of the Q2 reporting season that can really get particularly the mega caps and the large caps in the S&P 500 really going in the next couple of weeks. I think that really overshadows any kind of tariff headlines, any kind of Fed headlines that you were talking about earlier on as well. That's really the much more important thing, because again, I would be much less convinced about this if we went into this with earnings expectations of like 10% plus for the tech sector, but flat earnings growth with now an even weaker dollar and still pretty strong AI capex spending. That really is a setup that in the next few weeks into those earnings seasons, you don't want to go short into that. After sort of end of August, September, I think it's a different thing, because then there might be some more clouds coming on the fundamental basis, not necessarily tariffs, not necessarily the Fed, but much more sort of from a growth inflation mix backdrop.
It has been interesting, though, to look at a bond market that's maybe been more sensitive to some, at least, of the inflationary concerns coming out. I mean, I know there's a lot in this bond market right now between Powell and all of that, but we saw a 30-year yield go back above 5%, a 10-year yield hover around 4.5%. If it is an equity market that it is ignoring inflation at the moment, at what point do higher bond yields need to reawaken the concern that other risk assets maybe should be moving in lockstep with the bond market?
The answer is 4.7% on our estimates. So it's not, I've not just made that level up. It is slightly more sophisticated. So we've got a model called the danger zone, this danger zone where really it starts hitting all risk assets at 4.7%. Anything north of that on the 10-year will start to hit risk assets. One thing that we always got to remember with the bond market versus the equity market, or with risk assets overall, the relationship is highly nonlinear. It's very asymmetric. It doesn't matter. Higher yields don't matter until they are the only thing that matters, right? So, which sounds very stupid, but it's basically, it's not a relationship where you say, wow, bond yields are up 5 basis points, therefore now equities need to suffer. No, it really depends on, number one, the level, what kind of level there is where it really starts stoking fears in risk assets overall. And it depends on the velocity, how much it's going up, not only on one day, but really over a month. That is sort of 25, 30 basis points over a month. Once that hits, then, we're going to that danger zone, and the level is around 4.7% on the 10-year. That's when we start to get more concerned. Until then, we can thoroughly ignore it, and it's still quite a nice backdrop where yields can go up, but risk assets can still rally.
Hey, Max, just quickly, because I really want to squeeze this in. You also wrote in your note this morning that, ironically, tariffs could be the next bullish catalyst. We only have about a minute left, but what do you mean by that?
Yeah, it's not my desperate German attempt of being funny. It's not that. So it's slightly again slightly more sophisticated. Let's be honest around tariffs. Around the 9th of July, there's been a lot of hedges, a lot of concern around that. And just one tape 2 days before, we've had suddenly a new deadline reinstated. Let's not forget that this whole tariff issue, particularly the deadlines, they are not deadlines that are set in stone. They are not deadlines like the debt ceiling. They're not, mandated by law. Absolutely not. There's nothing in the way that in the next week or two, we could perhaps see really the administration saying, look, we actually are having really great negotiations with China, with the European Union. We just need a bit more time. Let's make a new deadline on the 1st of September or 1st of October, or maybe we won't have any deadlines. Already Besson, I think, was on with you guys on Bloomberg TV last week saying, look, and he said, look, I'm telling market participants not to worry too much about the US-China deadline. So already he is saying, yeah, it's actually not as much of a deadline, or not the word deadline per se. I think that is one thing. Again, it's one element in the wall of worry is that people perhaps are taking a little bit too literal. They taking it almost as economically inevitable. Whereas in my mind, it's a self-imposed thing that could actually just be extended by another month or by another 2 months. And is another element of the wall of worries that would then be taken out, and we could, as a result, see another squeeze higher.
Hey, Max, thank you so much for joining this morning. By the way, a belated congratulations. I saw you were voted #1 as a multi-asset analyst in 2025. Well-deserved. Max Kettner of HSBC. Looking forward to chatting again soon. All right, let's get you now some other top stories that are trending on the terminal this morning. Stellantis reporting a net loss of $2.3 billion in the first half. Restructuring expenses and U.S. tariffs hit the automaker. In North America, shipments fell 25% in the second quarter after a series of cost cuts. The new CEO attempting to clean house and stop a slump in sales and earnings. Elsewhere, Ryanair said that it will recover most of the fare drop it suffered last year, aiming to achieve reasonable profit growth in fiscal 2026. It did, though, caution that second quarter fare increases will be lower than in the first. Ryanair said travel demand is strong for the crucial summer period, helped by capacity constraints at other carriers. Meanwhile, Microsoft server software was exploited by unidentified hackers. The U.S. Cybersecurity and Infrastructure Security Agency said hackers accessed file systems and internal configurations. Microsoft said it released a new security patch to mitigate active attacks. Coming up, the EU prepares for no deal with the U.S. The U.S. is confident, though, that it can get one done. Your trade update coming up next on your brief.
I am confident we'll get a deal done, okay? And it will be great for America because the president has the back of America. So I think all these key countries will figure out it is better to open their markets to the United States of America than to pay a significant tariff.
11 days now away from President Trump's August 1st tariff deadline, Bloomberg reporting that the European Union is preparing for a no-deal scenario with the U.S. For more, we're joined by Bloomberg's chief European correspondent, Oliver Crook. And Oliver, this also follows off the back of FT reporting that the Trump administration would be looking at a 15 to 20% baseline tariff for the EU. What is the EU planning in return?
Yeah, well, we don't know at what level of asymmetry the Europeans are going to retaliate on the Trump administration. And that is going to be basically the major conversation that is happening now between all of the capitals, the ministers, the leaders of all of these European countries, which is at what sort of baseline tariff rate does Europe basically have to respond. We know that the window basically for tariffs is going to be between 10 and 30% in the event of a no deal by August the 1st. As you say, there's some reporting that narrows down to about 15 to 20%. But if you get a 15% or a 20% tariff on the EU, will they retaliate? We know from the president of the United States, any kind of retaliation of 5% tariffs, say, then that gets stacked up on top of whatever the U.S. has put forward. And that has really been the debate going forward, is how hardball do you play? How much stick do you bring to the carrot in these negotiations with the United States? States. We got the perspective from some of the major companies within Europe on that. I spoke earlier this morning both to the Siemens CEO as well as the Deutsche Bank CEO. Have a listen to what they're saying about how the sort of trade war is evolving and their view of it.
There's one point which is super relevant is we have to stop this uncertainty. So once there's a deal, the deal should be the deal. And then we can deploy capital again based on facts.
Most of the companies are not trending away from globalization. They are simply saying, how can we diversify and making sure that we are not too dependent from one or the other country.
And so two perspectives there from two very different German companies. You have Roland Busch from Siemens basically saying that at a certain point the uncertainty becomes worse than a bad deal with the United States. And Christian Sewing on the other side, which I think is really interesting, is saying that he's seeing a lot more interest from clients that are looking for a European alternative to U.S. banks, that this is one of the benefits, one of the silver linings from some of the instability we've seen in the United States.
All right, Oliver, really fantastic conversations you had there. I recommend everyone going onto the terminal at Bloomberg.com to look them on Germany's investment push. Oliver, thank you so much. That is Bloomberg's Oliver Crook. Now, coming up, Ishiba vows to stay on. The Japanese Prime Minister tries to buy time after yet another election setback. We're going to discuss that coming up next, and the yen's rally following that election. This is Bloomberg. You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning. First up, on the New York Times, members of Congress from both parties say they want to see more files released on the Epstein case. Days after the Justice Department asked a federal judge to unseal grand jury testimony, both Democrats and Republicans suggested the move was insufficient. Next up on the Wall Street Journal, reporting that Treasury Secretary Scott Bessent privately laid out his case to President Trump for why he shouldn't fire Fed Chair Powell. Bessent said firing Powell was unnecessary because the economy is doing well. By the way, Trump pushing back on Truth Social, saying he knows what's best, and that's why stock markets are at all-time highs. And on the Financial Times, Japanese Prime Minister Ishiba said that he will continue to lead Japan. The Liberal Democratic Party lost its majority in both houses of parliament. For the first time, he spoke at a press conference after the election results.
We, the Liberal Democratic Party, received a very severe judgment by the people in yesterday's upper house election. As the head of the Liberal Democratic Party, I apologize deeply for the upper house election result.
The yen strengthening against the dollar this morning, stronger by about 0.6% at 147.92 after the Prime Minister's announcement. Joining us for more on this story out of Tokyo is Bloomberg's Alice French. Alice, just how historic was this loss for Ishiba's party?
Yeah, so look, as you mentioned, this is not a good outcome for Ishiba or the LDP. Partly expected, I think, after they lost their majority in the lower house in October. But Ishiba and his ruling coalition failing to get those 50 seats that they need to maintain a majority in the upper house. That means he's going to have to move forward and rule the country without a majority in either house for the first time since the mid-1950s. So this is a pretty historic defeat. This comes amid a lot of sort of discontent amongst voters around the rising cost of living, inflation, etc. Like you mentioned, we did see the yen slightly gaining actually today. I think this is more on a kind of risk-off, safe haven move, and also partly some buying back after the weakening that we saw last year ahead of this election on caution. But we'll really see tomorrow how markets respond to this, because it has been a public holiday here today.
So maybe when more liquidity comes back, you see a different reaction. But Alice, the fact is that there is now less than 2 weeks for a tariff deadline for the U.S. on Japan and all the other nations. What impact does the election have as those trade talks continue on?
Yeah, the timing is really tricky, right? And Ishiba's position now really weakened domestically is not going to set him up well for pushing forward with those trade talks. We know that Japan's chief trade negotiator, Akazawa, has been back and forth to Washington multiple times, that we haven't really seen any concrete outcomes of those trade talks so far. I've been speaking to people here today. There's a lot of worry in the market that this may weaken Japan's hand even further. We know that Japan obviously is very reliant on exports, particularly in the auto sector. So the is a lot of worry amongst investors here about how that might impact stocks here, what it might mean for the yen. And as you say, time is ticking, and this is only going to make things more difficult.
Well, it probably makes things more difficult for the BOJ. How do they handle policy when there is political uncertainty right now?
Yeah, I mean, I think the general consensus is that the BOJ will probably have to push forward with those interest rate hikes at some point. But obviously, this policy uncertainty, particularly around government debt, is likely to perhaps slow down the pace of those hikes. I was speaking to some people today saying, you know, they were looking for at least one hike by the end of this year, and now the possibility of no hikes for the rest of 2025 has got higher. You know, government spending was a really big focus of this election. The opposition parties that have gained traction in this vote, several of them pushing for tax cuts to the consumption tax, concerns over how the government will fund that, particularly as Ishiba, you know, calls for more defence spending. So it's really, I think, casting a lot of doubt over the outlook for the BOJ and for fiscal policy in general.
Alice, thank you so much for that excellent update. That is Bloomberg's Alice French. And as we've been talking about the yen strengthening this morning, just under 150. Coming up, lack of conviction lingers in markets. We're going to catch up with RBC's Amy Wu Silverman, who outlines where the hedges are and are not. She joins your Bloomberg Brief coming up next. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Monday morning. Europe prepares for a fight. Less than 2 weeks until the U.S. trade deadline. The EU gets ready to push back. Ishiba holds on. Japan's Prime Minister vows to stay on to negotiate tariffs despite his party's historic Election Day loss. And Europe kicks off a busy earnings week. Stellantis takes a major hit. Big tech is on deck in the U.S. And the summer melt-up continues into that tech earnings season. Both Alphabet and Tesla report on Wednesday. Overall, 20% of the market by market cap. They barely moved on Friday, but here we go again, up about 1/3% for the S&P and NASDAQ. Russell 2000 outperforms. If we hold on to these levels, we will hit another all-time record today for this Treasury market. And probably part of the reason you're seeing small caps rally is because it is a Treasury rally. Off the back of some sizable bond market moves yesterday, questions of last week. Fed independence, hawkish details coming from the latest CPI, all of those helping to push 30-year yields around 5%. We're under that this morning. Some of the curve steepening eases off today. 437 is where you stand on your 10-year yield. Let's look at some of the stocks moving in the pre-market. With that is Valerie Teitel. Hey, Val.
Hey, Danny, let's start with a check on Stellantis that you did mention there. Those shares are down nearly 2%. They came out with some preliminary results for the first half, detailing a loss for the first half of the year, a $2.3 billion loss. There was some color about an impairment charge. They also had some color about their shipments to North America. Danny, the second quarter shipments to North America have dropped by 25% as this company continues to deal with Trump's auto tariffs. Let's move on to other companies that are going to be included in the S&P 500. This is a big win for Block, the payments company that owns Cash App and Square, up nearly 10% on the news that it will be replacing Hess in the S&P 500. This comes after Chevron acquired Hess on Friday. That successful acquisition led to Hess being delisted, and Block will be added to the S&P 500 effective on Wednesday. Lastly, some stocks to keep an eye on this morning that are reporting earnings before the bell. One of them is the big telecom giant Verizon, the first of the major telecoms to be reporting earnings this morning. Those shares are trading in the green. And one to leave you hungry, Danny, Domino's Pizza also reporting before the bell. Danny.
5:30 a.m. in New York, never too early for a slice of pizza. Valerie, thank you very much. Valerie Teitel there. Now, when it comes to the rest of this market, Amy Wu Silverman of RBC Capital Markets does see more room for them to grind higher, writing, quote, sentiment and positioning suggests a dramatic lack of conviction remains, but that also means if things come in better than anticipated, there is more room for investors to go jumping into the pool. An apt metaphor for a hot summer day. Amy joins us now, who's head of derivatives strategy at RBC. Amy, I think a lot of people wish that they were at a pool instead of at their desk trading these markets. I just want to start on the positioning, because here earlier in the program, we were talking to Max Kettner of HSBC, who said things are starting to look stretched and it's concerning him. So where do the differences lay? Where are you seeing that lack of conviction and maybe more upside to come?
You know, it's actually exactly that comment, Danny. I would call this a very reluctant rally. Folks know that valuation is stretched. People have been rather angsty given everything that is kind of overhanging. And because of that, you know, we've seen kind of this dichotomy between perhaps the retail investor base and the institutional investor base. I can tell you there's been more drag to that institutional investor base. But as things come in better than expected, you know, you have two big earnings this week from the Mag 7. There's sort of this forced jumping into the pool, if you will, because we still have this problem when things outperform that are high benchmark concentrations. You as an investor must participate as well.
This is interesting, Amy, this idea that it is uncertainty, because a lot of the conversation has been that it's complacency, that it's a market that simply doesn't care. Are you saying that that's the wrong narrative? It's just a market that is very uncertain where things go, so is kind of nervous to really bet one way or the other?
Yeah, look, I think it's fair for people to characterize complacency when you have a VIX kind of sub 17 handles. I would say two things. The issue has been that when you have been doing these consistent systematic hedges and the market continues to grind up, it's very hard to continue to hold them. That's not complacency. That's just the difficulty in the kind of being tactical about those hedging. I think, Danny, one reason that we see term structure and options heightened is because near term we are uncertain, but we haven't been placing those hedges well. But longer term, we are still quite worried. And then the second part of that is we are going into August where there tends to be these volatility potholes where you get an August 5th where VIX could suddenly spike to 65 because there are just these liquidity vacuums. And so I would be wary of that going forward.
What does that mean for how you should be positioning into an earnings season that might be coinciding with some of those volatility potholes, Amy?
Yeah, I would say two things. The first is, you know, because how the meat is made matters, because the concentration risk is so high in these stocks, you can use that to your favor as well. So to give you an example, we had this week both Google and Tesla reporting, obviously large factors in the weight of the S&P. They also make up a large component of the XLC, the S&P Communications ETF. And if you actually look at that volatility spread between Google and XLC, that's actually at a 5-year high too. So meaning when you think about the dispersion in this market, so essentially that differential between the index level option prices and the single stock, you can often use the ETFs as a proxy when you think about these major weeks when a lot of the weight of a certain ETF will report as well.
To look through some of the comments we got, your colleague Lori Calvasine, I thought, flagged a really interesting one from Fifth Third, the bank, the regional bank, saying you're seeing people make decisions, but it's not like a wild animal spirits risk-on sort of environment. Amy, what has been your read of earnings so far, both in what we've heard from companies and the market reaction to that?
Yeah, it's interesting because we were actually having this conversation about Netflix going into earnings. And if you just recall, you know, this was one that on the headlines, everything looked great. And it was a very muted, very underwhelming stock reaction. And when you had options pricing going into it, it was basically pricing about 2/3 of the 8-quarter median move. So one thing I would say is I think what's happening is you have all these historical moves that were sort of to some degree pandemic baked in, and those magnitudes look very high. Obviously, Netflix has, you know, they removed their subscriber numbers too, so that was unique to it. But I do think going forward, the animal spirits around earnings are, it's still wait and see. It's still a little bit early in terms of tariffs. We know there's going to be dribs and drabs, but even the management teams themselves are still waiting to hear what the final negotiations are. So it doesn't kind of surprise me that you're getting these underwhelming implied moves going into these earnings events when there's so much we don't know, Danny.
But Amy, so many people had said that this is an earnings season where the bar is really low. All these companies are going to be able to surprise to the upside, and then we'll see a rally. Why hasn't that played out? Because the bar had been low, or was it not low enough? What do you make of that sort of sentiment going into this season?
Yeah, you know, I would say it's still early. You know, we're really, you know, financials obviously kicks off the beginning of earnings, but we haven't really had the meat in terms of the concentration. So to me, that narrative could change. I do think it's interesting when you look at this week and the week ahead. the pricing you have seen in terms of the sentiment of options has actually been relatively bearish. I'll give you a good example. Usually, at least in the past kind of 5 cycles for NVIDIA, it's been incredibly bullish. Essentially folks are buying call options into NVIDIA earnings. Granted, NVIDIA reports late, but you're not seeing that at all. You're seeing very bearish sentiment. That's been a pretty interesting shift. I think it speaks to this kind of reluctant rally aspect. And then the secondary aspect of the wait and see, they're still playing in, or I think we would have seen that exuberance already, and we haven't seen that priced into derivatives.
Amy, there was some hope that you'd get a real rotation earlier in this month where you saw momentum really sell off in favor of value. You note that petered out pretty quickly. Is it your expectation that just continues in terms of momentum, AI, tech, the kind of market leaders continuing to lead, at least for the next several months?
Yeah. Danny, I joke that's the Lori Calvasina indicator because she's the pro on small caps. So she hasn't turned bullish. I don't know why I would either. I would tell you that a lot of that, I have learned from working with Lori is the high sensitivity to rates. And since, when you look at the pricing, it kind of looks like a lot of the cuts that we potentially would have has been delayed. And that's just not good for the small cap story. So, you did see kind of this huge magnitude shift between momentum and value, but just as quickly that snapped back. I think if we can't get the rate story straight, we can't necessarily get the small cap story straight. And that is what's being priced right now into the factor rotation.
Amy, we really appreciate your time this morning. Wonderful to kick the week off with you. Amy Silverman of RBC Capital Markets. Let's now get you some other top stories that are trending on the terminal this morning. Israel warns that it would move for the first time into a town in the heart of Gaza. It accused Hamas of stalling ceasefire talks. It had previously avoided the area for fear of harming hostages. The previous truce ended in May. A huge investment push from Germany's private sector. The country's top firms unveiled at least $116 billion worth of new projects to help lift the country out of stagnation. Deutsche Bank CEO Christian Saving spoke on this move on Bloomberg.
I think it's quite impressive what we have collected after a couple of months with over 600 billion of investments, 61 companies. And to be honest, I think more to come over the next months, but it shows what the sentiment is and that we have a chance.
And Microsoft server software was exploited by unidentified hackers. The U.S. Cybersecurity and Infrastructure Security Agency said hackers accessed file systems and internal configurations. Microsoft said it has released a new security patch to mitigate active attacks. And coming up, deal or no deal? Trade uncertainty rises as Brussels tools up for a no-deal scenario with Washington. We'll have the latest on your brief coming up next.
I am confident we'll get a deal done, okay? And it will be great for America because the president has the back of America. So I think all these key countries will figure out it is better to open their markets to the United States of America than to pay a significant tariff.
Less than 2 weeks until the tariff deadline set by the White House. At the same time, the European Union isn't as confident in the terms of a potential new deal. Envoys from the bloc are set to meet earlier this week to discuss how to deal with the U.S. if a deal cannot be reached. For more, we are joined by Bloomberg's Brendan Murray, who leads our global trade coverage. Brendan, where exactly do negotiations stand between the EU and U.S. at this moment?
Well, the European Union's trade negotiating team delivered a pretty stark message to officials in Brussels on Friday, and that was that they saw that the U.S.'s negotiating position was hardening up. There wasn't much flexibility in the tariff rate, the reciprocal tariff rate that currently stands at a threat of 30%. The European Union wants that to be 10%, basically right at the baseline. And there was some other sectoral tariff relief that the Europeans are looking to get assurances on, and those aren't forthcoming as well. So we heard Commerce Secretary Lutnick say he's confident in the fact that they will get a deal, but he didn't say that deal was going to be great for Europe. He said that deal was going to be great for America. So the Europeans are increasingly looking at this like a scenario that's going to be out of balance, not in their favor, and they're looking to take what next steps they might go down in terms of retaliation against American exports.
What might those retaliations look like, Brendan?
Well, they have about $100 billion worth of U.S. products targeted, from Boeing airplanes to bourbon and some other, and soybeans and sort of, kind of all American type products that they could initially start off with. They also have something called an anti-coercion instrument, which is sort of the nuclear option. They could start going after U.S. tech companies. There's not a majority, an agreement on whether that should be used at this stage, but the calls for that instrument to be used are growing, and that's in the all-out transatlantic trade war scenario. We're definitely not there yet, but we only have 2 short weeks left to put this deal together before those tariffs kick in on August 1st.
2 short weeks, Brendan. Besides the EU, who else are we looking out for some potential movement ahead of that?
Well, we've reported that the South Koreans are in Washington this week. Japan still thinks that, just off of its upper house elections, is still thinking it can try to get a deal. That Taiwan is also in the mix. India is still in play. All of these, especially the Asian countries, are looking to get their reciprocal tariff rate somewhere around 20%. Indonesia's got the 19%. So if all of Asia can get theirs to be around 20, that seems like a number that they could all live with. That wouldn't be too much disparity regionally. So between the Europeans, the Swiss are also have a deal on Trump's desk that hasn't been approved yet. So there are a number of these in the works that could come together between now and the end of the month.
Hey, Brendan, thank you very much for that update. Bloomberg's Brendan Murray. Now, another sector we're keeping our eye on this morning, airlines, from earnings to other issues. On the issue side, Alaska Air has resumed flights after temporarily grounding its fleet late Sunday following an IT outage. We also learned that Delta had recently moved aggressively to avoid colliding with a B-52 jet. For more, we're joined by Bloomberg Managing Editor for Aviation and Space. It is Benedict Campbell. Benny, good morning to you. A lot of things going on here. I wonder, when it comes to Alaska and Delta, if there's a commonality of things underpinning these potential mistakes that, of course, were avoided. Is there an issue of a lack of investment, or is something else going on here?
Well, that's usually the question that does come up, sort of what is the state of the industry, the software that is being used, what is the state of the personnel. We've heard quite a lot about this since the mid-air collision in January in Washington. Is the U.S. air traffic control properly staffed? Is there too much human error? Is there an issue with software? This is something that Alaska will have to take a very hard look at. These outages happen. Thankfully, they don't happen very often. But when they do happen, they sort of chip away at the public's sort of sense of safety. And that is obviously an important part of aviation. People want to feel good about getting on a plane. They want to feel safe. They want to feel that the technology, not just of the aircraft, but also everything that surrounds it, is up to snuff. And obviously, events like this with Alaska, yes, it was short-lived, but that doesn't help. The Delta issue, again, mid-air collisions or runway collisions, extremely rare, but when they do happen, they can be absolutely fatal. So this will be investigated quite aggressively. But 2 events that don't help sort of instill a faith of optimism in the industry.
Well, one place in this industry that definitely has optimism, Benny, you've been looking at their earnings all morning. It is Ryanair, the budget airline, seeing their profit more than double. What underscores that strong demand?
Well, there's a couple of things. Quite simply, people like to travel for the summer period, and Ryanair is in a good place. They have a huge network across Europe. They're expanding into favorable markets like Scandinavia, like Southern Europe and Spain and so on. So that's really helping them. They've got costs under control. But they're also benefiting to some degree from the missteps and the misfortunes, shall we say, of some of their rivals. Wizz Air, that's the Hungarian low-cost rival. They've had big issues with aircraft because of the engines that they had to take off and repair. EasyJet has had some issues with air traffic control. That's something that Ryanair has been able to sort of sidestep to a greater degree. So it's both the product, but also sort of what's going on in the broader industry. They also have the advantage of Boeing aircraft coming back into their system at a greater clip. They had real issues about 6 months to a year ago where there were the massive delays on Boeing aircraft. That seems to be behind them now. They are getting the kit that they need. They are getting the lift, and this is right ahead of the crucial summer period. And you see it in the stock price. A lot of analysts are upgrading their forecasts, saying this is early in the year for them in the fiscal year. So there's upside here, and you can see it in the stock. It was up 10% at one point this morning.
Yeah, now up just under 7%. Benny, thank you so much for that. That is Bloomberg's Benedict Campbell. Now, it might be a different story for Stellantis, the car maker reporting a brutal first half, a near $3 billion net loss, restructuring expenses, waning sales, U.S. tariffs, all impacting a role, or playing a role, rather, in the results. For more, joining us is Bloomberg's Albertina Torsoli. Albertina, I mean, these are really some ugly numbers. What were driving them?
There's various things at play here. There's a lot of focus on U.S. tariffs, and clearly, President Trump's tariffs or the various announcements in the first part of the year of what he would and wouldn't do on that front didn't help. The company announced today, and this was a preliminary announcement, a surprise announcement, because their full-fledged first-half earnings are due on July 29. The tariff impact was a net impact of 300 million euros, so about $350 million. But there's more to the story. There's a new CEO to the story. There's been a very difficult 2024 for the company, and there are tough decisions that are being made, investments that are being, moved around, reassigned, and a pretty big move from the full-fledged push into electric vehicles that was, what defined the era of the previous CEO, Carlos Tavares, into other areas, notably hybrid vehicles, closure of plans, decision to drop investments in hydrogen. So this is really the first step that the new CEO, Antonio Filosa, is making to reset expectations. Analysts are calling it a bit of kitchen sinking, but also really reshifting the priorities here at the company at a very difficult time for the industry.
That's for certain. Shares down 2%. Albertina, thank you so much. Albertina Torsoli there. Coming up, we're going to get you set up for your week ahead. That includes some big Mag 7 earnings on deck. That's coming up next on your Trading Diary. This is Bloomberg. Let's get you set up for your trading week. Big tech earnings will be kicking off Tesla and Alphabet. They both will be reporting on Wednesday. Then we'll get Intel. They report on Thursday. Also on Thursday, we'll get U.S. PMIs and jobless claims data. Now, in the meantime, let's look at some of the stocks on the move pre-market block. One of them, a rally underway. It's going to be joining the S&P 500, up 9.6%, getting some of that passive flow. It will be replacing Hess after Chevron finally successfully bought the company. Sarepta, that's been cut to neutral by Mizuho. Price target is at $14, trading just below that, down 1.7%. It has also refuted an FDA request to pull its gene therapy. Finally, Tesla, that is leading the Mag 7 stocks higher this morning, up just under 1.5%. It will be reporting earnings later this week, as we mentioned, on Wednesday. A big earnings week, 20% of this market reporting based on market cap. All right, a quick look at your bond market because a rally is underway after some decline, some steepening all last week. That reverses somewhat this morning. 30-year yield down nearly 4 basis points. All right, that's it for your brief. Surveillance takes things from here. You're watching Bloomberg.